This is the end of the year, the last show. So normally we go over weekly. Let's go over year to date, and the numbers are big. First of all, let's look at the total year to date flows, $324 billion. That'll be the second biggest year of ETF flows ever. 7% organic growth so that's nice, steady growth. Let's look at the top leaderboard of the year, right? VTI, broad market, everybody just piling in. VU, that's S&P. Look at that, 31%. That's the best return for the S&P since 1997, even though it didn't feel like that all the time. USMV is a shocker. This should not be this high. Minvol was a huge breakout this year. That's interesting for smart beta. And then also note VU above IVV. It cut its fee by 1 basis point. That was enough to sort of win this little internal flow battle. And look at all the bond ETFs on there. That's that hangover from 2018 and rates falling. Let's look at the asset classes. For the tail of 2 years, you can see January through October, equity is not that big. Look at them, 40% of their flows in the last 2 months. But look at international, more in the past 2 months. Fixed income, look at that versus look at that drop off, right? And then gold as well, drop off. But look at their growth this year. A little below average, but look at that. 18% for fixed, that's way above average. It's biggest year ever. Also gold, not slacking there. Now let's look at the leaderboard in terms of the issuers who won and lost. And for the 6th straight year, BlackRock will have taken in more flows than anyone else. Vanguard was flirting with winning, but BlackRock pulled ahead. Schwab, always number 3. But don't sleep on JP Morgan and Goldman as we move forward. These two and Deutsche Bank, the Wall Street banks, are very good at taking in money. So, Scarlet, look, interesting year. The end of the year reminded me of 2017 with everybody feeling bullish. Next year should be very interesting.
Yeah, everyone's breathing a sigh of relief. It's not like the end of 2018. All right, Erica is not our only ETF savant here at Bloomberg. I want to welcome Athanasios Psarofagis, our ETF analyst for the EMEA region, and James Seyffart, our New York-based ETF analyst. James, let me start with you. Eric shared his tale of 2 years. And he mentioned fixed income, but maybe he didn't do it enough justice because it was a record year for fixed income, wasn't it?
Yeah, this was the biggest year that fixed income ETFs have ever seen. And within that, we've seen junk bond or high yield ETFs taking more money than they ever have at 20 billion. Muni ETFs have taken in a record number at 10 billion. And what this is more a story about investors and institutions getting more comfortable with fixed income ETFs as a whole. And we see this is going to go forward.
Yeah, and Tom, let's talk about, you did a summary of the whole decade, right? It's the end of the decade, too. Talk about the winners and losers performance-wise of the decade.
Yeah, I mean, if we look at the 2 decades, right, so let's look at this first one. It's been all pro-growth, pro-America, right? Semiconductors, medical devices, internet stocks, defensive names, right? That's what's really led this decade. If you look at the decade before, 2000, 2010, it was all energy, XLE, and any country that was tied to energy, so like Mexico, Canada, Australia. So very different decade. The second half of it, very pro-growth, very pro-America.
Okay, so very commodity-driven, certainly, in the previous decade. It brings to mind what's going to come up in 2020 and the decade to follow. And I suppose one thing that you can look at is smart beta, because the inflows into smart beta have reached $1 trillion. There's that 3 commas.
Yeah, so record year for smart beta, reaching $1 trillion, just as we have these ants, or active non-transparent, hoping to come in. Talk about this interesting turf war over the future of active, smart beta versus non-transparent active.
Sure, I think smart beta fills a lot of that void, right? And you sort of mentioned USMV, right? So that putting smart beta assets over $1 trillion, that's a quarter of all ETF assets. So now when you think about these active non-transparent, they're not only competing with just really cheap core, they're competing with smart beta. I think that's really who they're competing with. And then if you also look at just over time, smart beta costs will come down a lot, right? So they're going to be competing on these really cheap smart beta products. When they start coming in.
James?
Yeah, I mean, you can't really sleep on these products because, one, there's trillions of dollars. There's asset managers with trillions of dollars betting big on these things. And also, there's other ways they can gain assets. If they convert some of their mutual funds that are seeing outflows in a way to stem outflows to these ant products, that could be a way that these things could get assets real quick.
Okay, so it could be a big secular change for that part of the investing world. One thing I feel like we need to talk about this year is ESG, because it feels like it went mainstream this year. I mean, people are talking about it a lot more.
Yeah, that's the word on the street. I hate to be the bad guy. It's tough to be
You're
against.
skeptic.
I know. ESG definitely doubled its assets this year, but it's still only 0.4%. Given the hype, I think that's underwhelming. And also, we did a study. What ESG ETFs don't include, a lot of them don't have Amazon, Netflix, Berkshire Hathaway. I think people are going to be kind of shocked. I think a lot of education is needed. James, you're a little more bullish. Give me the bullish case for ESG.
Well, for one, they've taken in $8 billion this year, which is a big number, especially for ESG ETFs. Again, not huge in the grand scale of ETFs. But the way I look at this is similar to the way that I look at smart beta ETFs. The watered down things with a lot of beta are getting all the assets. The newer ESG ETFs are similar. They're excluding a couple of assets, a couple of securities. And also some of the companies that Eric mentioned are more, there are some real governance issues with them. So it makes sense if you're going to go ESG that they would be excluded. But again, we're a little more bullish on the ESG type of, the watered down ESG type products.
And Tom, of course, ESG is much bigger in Europe. It's a lot more developed there.
It is. They seem to be a little bit warmer to ESG. Maybe about 5% of assets are in ESG ETFs in Europe versus like less than 1% here. And the other thing, a lot of it's regulatory. So even benchmarks now in Europe all have to disclose their ESG ranking. So a lot of it is just being pushed into that direction. And then also here in the US, the products that took in a lot of money, the bespoke funding, that was a European pension fund that was putting money into it. So it's just, they're just being driven towards that. So that's why it's taken off a little bit more in Europe.
All right, and of course, final point here is that there have been some big numbers associated with calls for ETF flows and assets. And B of A Merrill Lynch's Marianne Bartels, Eric, has a big number out there. And you put it out to Twitter to see if everyone would agree.
Yeah, and I have a lot of people who are in the ETF industry who follow me, but I was shocked that many people agree with her that 50 trillion will be what they have in 10 years. I'm more in the 20 trillion camp. What do you guys think?
I'd probably take the under on that. I think there's a lot of things, also in the last 10 years, if you factor in the growth rates, a lot of it was the market too. So, the market might not be might not have that big bull run that we had in the last 10 years. So I'd probably take the under on the 50 trillion.
I'd probably put, if I had to say a number, I'd say 25, but that would be pretty bullish on international markets.
Okay. All right. Final question to all of you guys. Lightning round. What is one ETF that you're watching in 2020 and why? Eric, we'll start with you.
B-Bus from JP Morgan, because they have 23 billion in SPY, and if JP Morgan moves even a little bit into B-Bus, look out. That thing could be a multi-billion-dollar ETF.
James?
I'm going to cheat a little bit and go with a group of funds or defined outcome funds. Innovator Funds was the first one to come out with them, and basically they buffer you against a certain percent of losses. They cap your upside, but it could be a way for ETFs to compete with structured products and annuities going forward.
All right. UGen, BGen, and PGen are examples there. And Athanasios?
I'm going to go with Goldman's GSLC. It's already a big product, but I think one big difference for them next year is they bought United Capital, they bought S&P Model, so they have a lot more distribution going into next year that I think they can place that product in.
All right, GSLC, BBUS, and those defined outcome names.